What if I told you that the greatest investor of all time, the man worth over $100 billion, once made a single mistake that cost him $8 billion? Yes, Warren Buffett, the master of value investing, admits that even he has made massive blunders, not because of bad luck or bad math, but because of human psychology, the same traps that destroy ordinary investors every day. He once said, "The biggest mistakes are not the ones you make, but the ones you failed to act on." And one of those mistakes was when he hesitated to buy Walmart. He loved the company, understood its potential, but argued with himself over a few cents per share. Years later, he called it an $8 billion hesitation. The cold truth is this: you don't have to be stupid to lose money. You just have to be human. Whether you're Warren Buffett or a first-time investor, you will face the same psychological traps: fear, greed, overconfidence, hesitation, and they can quietly erase decades of progress. So in this video, we're breaking down the 10 biggest investing mistakes that even Buffett himself admits making. Mistakes that cost him billions and that can cost you your future if you don't spot them early. And it all starts with the most common illusion in the market: the belief that you can outsmart time itself. Most people see Warren Buffett as a genius who never loses. But if you listen closely to his interviews and shareholder letters, you'll hear a completely different story. Buffett has made billion-dollar mistakes, and he openly discusses them. The difference is that Buffett never lets his ego hide those failures. He studies them, he learns from them, and he uses every loss as fuel for better decisions. That mindset is what separates the world's greatest investors from everyone else. This video is not just about stocks or money. It's about behavior. Because investing success is never about IQ. It's about EQ, emotional intelligence, the ability to stay rational when everyone else is losing their minds. Buffett's power doesn't come from luck or secrets. It comes from discipline, humility, and patience. The more you understand that, the more you realize wealth isn't built on prediction, but on principles. So if you want to learn how to think like Buffett, avoid the mistakes that cost him even billions, and start building wealth with calm confidence, make sure to subscribe. This channel is where we decode the psychology, mindset, and strategies behind the world's smartest investors. Now, let's begin with the first and most dangerous mistake of all: the illusion that you can predict where the market is going. Mistake number 1: trying to time the market. It sounds simple: buy low, sell high. Everyone says it, but almost no one does it. Why? Because in real life, nobody knows when low or high truly is, not even Warren Buffett. Buffett has said countless times, "I have never been able to predict the market. What I can do is decide whether an investment makes sense." He does not try to outsmart time. He focuses on quality businesses, and then he waits, sometimes for years, while everyone else jumps from one trend to another. Cold truth: trying to time the market is just another form of gambling disguised as intelligence. Look at what happens every time fear hits. Investors panic, sell their holdings, and promise to buy back in later. However, by the time they feel safe again, prices have already risen. They miss the recovery and repeat the same mistake. During the 2008 crisis, Buffett didn't panic. He bought more. While others were trying to guess where the bottom was, he focused on companies he understood and trusted. 10 years later, those same investments multiplied. Timing the market is about ego wanting to be right. Investing is about patience and a desire to achieve wealth. Here's Buffett's rule: be fearful when others are greedy, and greedy when others are fearful. It sounds simple, but it requires emotional control that few have. So if you catch yourself waiting for the perfect time to invest, remember this: the best time was yesterday, and the second best time is today. Now that we've destroyed the illusion of market timing,
Let's look at the next deadly mistake, one that traps even disciplined investors: the mistake of falling in love with your purchase price.
Mistake number 2. Getting attached to your purchase price. Every investor remembers the exact price they paid for a stock. It becomes personal. You tell yourself, "I'll sell when it gets back to what I paid." But the market doesn't care what you paid. It doesn't even know you exist. Warren Buffett calls this one of the most dangerous emotional traps in investing. Once we buy something, our brain creates ownership bias. We defend it, justify it, and ignore new information that says we might be wrong. Cold truth, your purchase price is a memory, not a strategy. Imagine 3 people who all bought shares of the same company at different times, one at $100, one at $120, and one at $150. They all own the same stock, but each sees it differently. One feels proud, one feels nervous, one feels regret. The company's value hasn't changed, only their emotions have. Buffett says investors must be willing to admit when a decision no longer makes sense. The stock doesn't know you own it, he reminds us. You are not married to your investment. Smart investors make decisions based on facts, not feelings. They ask one question: would I buy this company today at this price? If the answer is no, they sell. When you detach from your ego, you free yourself to make rational choices, and that's exactly what you'll need to do to avoid the next big trap, one that has destroyed fortunes for decades: believing in unrealistic growth stories.
Mistake number 3. Believing in unrealistic growth stories. Every decade has its miracle companies. In the 1990s, it was dot-com startups. In the 2000s, it was real estate. And today, it is AI and tech stocks. People convince themselves that this time is different, that prices will go up forever. But Warren Buffett has seen this movie before, and he knows exactly how it ends. He once said, "It's a mistake for any company to predict 15% growth year after year." No business can outpace reality forever. Markets mature, competitors appear, and optimism fades. Cold truth: growth is not infinite. It is a story, and stories can change overnight. Buffett learned this lesson early. In the 1970s, he invested in companies that looked unstoppable. Perfect numbers, glowing headlines, endless optimism. But over time, they saw that even great businesses stumble when expectations become impossible to meet. The real danger isn't just losing money, it's losing discipline. When you believe the hype, you stop asking hard questions. You start hoping instead of thinking. His rule is simple: always separate a company's story from its reality. Look at cash flow, not headlines. Look at management, not promises. As Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Next, we'll examine a mistake that turns smart people into bankrupt individuals using leverage to chase faster results.
Mistake number 4. Using leverage to accelerate returns. Imagine an intelligent investor named Daniel. He studies the market, finds a promising stock, and decides to use margin, borrowed money, to double his position. For a while, everything goes perfectly. The stock rises, his confidence grows, and he feels unstoppable. Then, the market drops 10%, and Daniel's account collapses overnight. The bank calls in the loan, and he is forced to sell everything at the bottom. This is how leverage destroys people who should have won. Warren Buffett is very clear about this. Leverage turns a sound investment into a dangerous one. The only way a smart person can go broke is by using borrowed money.
Cold truth? Leverage gives you speed, but it also removes your ability to wait. When you invest with cash, you can ride through the storm. When you borrow, you lose patience. A small decline becomes a disaster. And the sad part is that leverage often begins with greed, not necessity. People don't use it. They must use it because they want more, faster. Buffett has watched brilliant investors fall prey to his exact trap. They were not wrong about the company. They were wrong about their own limits. He and Charlie Munger built Berkshire Hathaway without leverage, slowly, steadily, with patience and discipline. That's why they could survive every crash. If your plan depends on debt to succeed, it's not a plan, it's a gamble. So before you borrow to invest, ask yourself a question Buffett often repeats. Would you still sleep well if the market dropped 50% tomorrow? If the answer is no, you are already over-leveraged. The next mistake might seem harmless, but it's one of the most subtle killers of wealth: losing sight of the big picture. Mistake number 5. Missing the forest for the trees. Many investors fall into a dangerous illusion. They believe that the more numbers they analyze, the smarter their decisions will be. They spend hours reading quarterly reports, memorizing ratios, building spreadsheets, and still lose money. Warren Buffett says it best: you don't need to know how a car engine works to drive to your destination. In investing, the same rule applies. Focusing too intently on every detail can cause you to overlook the obvious. Cold truth: perfect analysis doesn't equal ideal judgment. Buffett once shared that the 3 most important things he looks at are simple: business economics, management quality, and price. If those 3 make sense, everything else is noise. Too much information creates paralysis. You start second-guessing every move, waiting for perfect data that never comes. By the time you act, the opportunity's gone. Smart investors know that analysis is a tool, not a hiding place. The goal isn't to predict every number. The goal is to understand the story behind those numbers. So the next time you find yourself lost in data, step back and ask, do I understand how this business actually makes money? If the answer is yes, you have enough information to make a decision. Now let's look at the next mistake that even professionals can fall into: turning simple investing into something unnecessarily complicated.
Mistake number 6. Overcomplicating simple investments. Investing doesn't have to be complicated, yet many people make it that way. They chase exotic strategies, complex financial models, and secret algorithms. They think the harder it sounds, the smarter it must be. But Warren Buffett built one of the greatest fortunes in history by doing the exact opposite. He says, why jump over a 7-foot bar when you can step over a 1-foot bar? Simplicity is not a weakness, it's an advantage. Cold truth: complexity kills returns. A famous example is long-term capital management, a hedge fund run by Nobel Prize winners. They had the smartest equations, the best data, and total confidence. But their models ignored one crucial aspect: human behavior. In 1998, they lost billions and collapsed, relying on the Federal Reserve to be rescued. Buffett and Munger watched from the sidelines, untouched, because they understood a timeless rule: what you don't understand can destroy you. The best investments are often boring. Businesses that sell everyday products, have loyal customers, and predictable cash flow. Buffett once said, if you need a computer to understand it, don't buy it. Simplicity creates clarity, and clarity creates confidence. That's how you stay calm when the world panics. But there is another powerful force that destroys rational thinking. It doesn't come from data or logic, it comes from other people. The next mistake is following the herd. Mistake number 7. Following the herd. Imagine this. Everyone around you is making money. Your friends brag about their new stock picks. The news headlines are full of record highs. And social media is shouting one thing: buy now or miss out. You start to feel the pressure. If everyone else is doing it, it must be safe, right? That is the trap of herd mentality. Warren Buffett has seen it in every market cycle, in the dot-com bubble, in the housing boom, and in every cryptocurrency rush since. When crowds lose their minds, logic disappears. Prices stop reflecting value and start reflecting emotion. Buffett's rule is brutally simple. Be fearful when others are greedy, and greedy when others are fearful. Cold truth. The crowd feels comforting, but it is usually wrong. When everyone agrees, opportunity is gone. The best investors learn to stand apart, even when it feels lonely. They buy when others panic and sell when others celebrate. It sounds easy, but in practice, it is one of the hardest disciplines in finance. During the 2008 crisis, Buffett invested billions when the world was frozen by fear. That courage wasn't luck. It was conviction built from independent thinking. If you want extraordinary results, you must be willing to look foolish in the short term. Following the herd may protect your ego, but it will never build your wealth. Next, let's examine a mistake that seems smart, but quietly undermines its performance through over-diversification.
Mistake number 8. Over-diversifying. Most investors are taught to never put all your eggs in one basket. It sounds safe, even wise. But Warren Buffett completely disagrees. He says, diversification is protection against ignorance. It makes little sense if you know what you are doing. Buffett believes that too much diversification is just another form of fear of being wrong. When you own 50 or 100 different stocks, you no longer have a strategy. You have a collection. Cold truth is, owning too many investments is just a way to hide uncertainty. Buffett and Munger built Berkshire Hathaway by focusing intensely on a few great companies they understood: Coca-Cola, American Express, Apple, and Geico. They didn't scatter their attention, they concentrated it. And because of that, every decision mattered. Most people think they need endless variety to reduce risk, but in reality, spreading yourself too thin dilutes your gains. Buffett's philosophy is clear. Know your circle of competence and stay within it. He once said, if you have 6 good ideas in a lifetime, that's plenty. The point isn't to avoid diversification completely. It's to invest only where you have conviction. If you don't understand it, don't buy it. The next mistake comes from the opposite problem to doing too much, but doing too little. It's the silent killer of wealth, staying too passive and missing opportunities.
Mistake number 9. Staying too passive. Fear of action. Most investors lose money not because they act recklessly, but because they fail to act at all. They see a great opportunity, hesitate, and wait for a better entry point. By the time they finally move, the moment is gone. Warren Buffett cares for these mistakes as stakes of omission, the times you knew what to do but didn't. He admits these cost him far more than his bad investments ever did. One of his biggest regrets is not buying more shares of companies he already understood deeply, such as Walmart or Google. Cold truth, doing nothing when you know what to do is still a mistake. Fear disguises itself as patience. We tell ourselves we're being careful when in reality we're being paralyzed. Great opportunities rarely announce themselves twice. Buffett's success comes from acting with conviction when the odds are clearly in his favor. He once said, "Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble." This doesn't mean rushing into every deal. It means recognizing when everything aligns in terms of value, quality, and timing, and then acting decisively. If you truly believe in your analysis, hesitation is just another form of doubt. Trust your preparation, not your fear. Because while inaction feels safe, it's often the most expensive decision you can make. And finally, we arrive at the most fundamental mistake of all, and one that fuels every bad decision in investing: misunderstanding human psychology.
Mistake number 10. Ignoring psychology and behavior. Warren Buffett often says that investing is not a test of intelligence, it's a test of temperament. The market doesn't reward the smartest person in the room, it rewards the calmest. Buffett's partner, Charlie Munger, studied human psychology for decades. He called it the study of human misjudgment. Together, they realized that markets don't move on logic, they move on emotions, such as fear, greed, envy, and overconfidence. Cold truth. You have the best analysis in the world, but if you lose control of your emotions, you lose everything. Most investors don't fail because they don't know enough. They fail because they know too much and feel too much. They have become attached to their opinions, and when the market challenges them, they defend their ego rather than their portfolio. Munger once said, "The human mind is like an egg. Once a belief gets in, it's almost impossible to remove." To win, you must learn to question your own certainty. Before every big decision, Buffett asks himself, "If I didn't already own this, would I buy it today?" That single question keeps him honest. Mastering psychology means mastering yourself. The market is unpredictable, but your reactions don't have to be. Now that we've explored these 10 mistakes, let's consolidate them into a timeless formula that explains why Buffett continues to win decade after decade.
When you study Warren Buffett long enough, you realize something profound. His success was never about being the smartest man in the room. It was about avoiding foolishness, staying patient, and letting time do the work. Here are the 10 lessons worth remembering. Don't try to time the market. Forget your purchase price. Beware of unrealistic growth stories. Never use leverage. Don't get lost in the tails. Keep things simple. Ignore the crowd. Don't over-diversify. Don't freeze when opportunity appears. Master your psychology. Buffett's real genius lies in restraint. While others chase quick profits, he builds foundations that last decades. He plays a different game, not based on discipline, simplicity, and emotional control. Cold truth? You don't need to predict the future to win. You just need to stop doing the things that guarantee you'll lose. So here's your challenge. Revisit your portfolio, your mindset, and your habits. Which of these 10 mistakes are you still making? Write it down, fix one at a time, and you'll already be ahead of most investors. And if you want to truly understand the man behind the wisdom, his habits, mindset, and the decisions that shaped his empire, your next video should be The Snowball, Warren Buffett and the Business of Life by Alice Schroeder. It's the definitive look into Buffett's philosophy and how he turned simple principles into one of the greatest financial stories in history. Check it out right here, and don't forget to subscribe for more insights that sharpen your thinking, protect your wealth, and help you play the long game just like Warren Buffett.